In the world of investing, few names resonate as strongly as Benjamin Graham. His masterpiece, The Intelligent Investor, first published in 1949, remains one of the most influential books on investing ever written. The Intelligent Investor offers a timeless framework for navigating the complexities of the market. Graham's principles, focusing on value investing and long-term growth, remain as relevant today as they were decades ago. This video will delve into the core lessons from The Intelligent Investor, providing viewers with practical insights. In The Intelligent Investor, Benjamin Graham draws a crucial distinction between investors and speculators. An investor prioritizes the thorough analysis of a company's underlying business and its intrinsic value. Speculators are driven by short-term market fluctuations and the allure of quick profits. Graham cautions against excessive speculation, as it can lead to impulsive decisions and ultimately erode long-term wealth. The difference between investing and speculating boils down to their respective approaches to risk and reward. Investors prioritize minimizing risk while seeking reasonable returns over time. Speculators often prioritize maximizing returns, overlooking potential downsides. By grasping this crucial distinction, individuals can make informed decisions aligned with their financial goals and risk tolerance. For long-term financial success, strive to be an intelligent investor, not a speculator. Sustainable wealth is built on a foundation of sound investment principles. By adopting the mindset of an investor, focusing on value, managing risk, and remaining patient, individuals can navigate the market with greater confidence. One of Benjamin Graham's most enduring concepts is the personification of the market as Mr. Market. Imagine Mr. Market as an unpredictable character who approaches you daily, offering to buy or sell stocks at various prices. Some days, Mr. Market is exuberant, driving prices to irrational highs. On other days, he's gripped by fear, sending prices plummeting without justification. Graham's point is that the market's short-term fluctuations are often driven by emotion, not logic. As intelligent investors, we must not let Mr. Market dictate our decisions. Develop a disciplined approach grounded in fundamental analysis. When Mr. Market is euphoric, resist the urge to get caught up in the frenzy. When fear dominates, view it as an opportunity to buy undervalued assets. Mastering emotional discipline requires patience, a crucial trait for any successful investor. Investing is a marathon, not a sprint. Focus on building a well-diversified portfolio of undervalued assets and allow time for your investments to compound. The market is like the ocean, prone to storms and periods of calm. By understanding that volatility is inherent in the market, we can better weather the inevitable downturns. Mr. Market's irrationality is an opportunity for the disciplined investor. By maintaining emotional discipline, focusing on value, and staying patient, we can harness the power of the market to build long-term wealth. Benjamin Graham emphasizes the importance of the margin of safety as a central tenet of intelligent investing. Think of the margin of safety as a financial cushion, a buffer protecting you from potential losses due to unforeseen circumstances or errors in judgment. Graham's concept of the margin of safety centers around buying assets at a significant discount to their intrinsic value. By purchasing assets at a price significantly lower than their intrinsic value, investors create a cushion that protects them from potential downsides. The margin of safety is essentially a risk management tool, mitigating the inherent uncertainty in investing. By buying with a margin of safety, you're essentially buying a dollar for 50 cents, giving yourself a cushion to absorb potential losses. Graham believed that a true measure of successful investing is not just about maximizing returns, but also about achieving peace of mind. Investing with a margin of safety allows you to sleep well at night, knowing that your portfolio is built on a foundation of solid value. By adhering to this principle, you can approach investing with a sense of calmness and rationality, making sound decisions that contribute to long-term financial well-being. In a world bombarded with stories of overnight successes and get-rich-quick schemes, it's easy to fall prey to the allure of short-term gains in the stock market. The financial media often amplifies this temptation, highlighting day traders who seemingly turn small sums into fortunes overnight. However, Benjamin Graham's The Intelligent Investor cautions us against this seductive but often perilous path. Instead of seeking quick wins, Graham advocates for long-term thinking, emphasizing the power of compounding as the investor's greatest ally. Compounding is the snowball effect of earning returns on your initial investment and then earning additional returns on those earnings over time. The longer your money remains invested, the more powerful this effect becomes, turning even modest initial investments into significant sums over decades. To harness the power of compounding, two key ingredients are required: patience and discipline. The market's unpredictable nature often tests even the most seasoned investor, with periods of stagnation or decline tempting us to abandon our long-term strategy. By focusing on the intrinsic value of our investments and tuning out the noise of short-term market fluctuations, we can remain steadfast in our long-term approach. Embracing long-term thinking and investing is about building a legacy for future generations. By allowing our investments to compound over decades, we create a financial foundation for our children and beyond. The best time to plant a tree was 20 years ago. The second best time is today. Active investing involves a hands-on approach to portfolio management. Active investors meticulously research individual stocks, bonds, or other assets, aiming to identify undervalued opportunities and outperform the broader market. This approach requires significant time, effort, and a deep understanding of financial markets. Passive investing takes a more hands-off approach. Instead of trying to beat the market, passive investors aim to match its performance by investing in index funds or exchange-traded funds, often called ETFs, that track a specific market index, such as the S&P 500. Passive investing requires minimal trading and often comes with lower fees, making it an attractive option for investors seeking simplicity and cost-effectiveness. The choice between active and passive investing is not one size fits all. It depends on your individual circumstances, risk tolerance, time commitment, and financial goals. If you enjoy delving into financial statements and researching companies, active investing might pique your interest. However, if you prefer a more hands-off approach, prioritize low costs, and value simplicity, passive investing could be a more suitable choice. Active and passive investing are not mutually exclusive. Many investors choose a blended approach, utilizing both strategies within their portfolios. This blended strategy allows investors to benefit from the diversification and cost-effectiveness of passive investing, while potentially enhancing returns through targeted active management. In the realm of value investing, understanding a company's intrinsic value is paramount. Intrinsic value represents the underlying worth of an asset based on its fundamental characteristics and future earnings potential. To determine intrinsic value, Graham proposed a practical formula, often referred to as the Graham formula or the intrinsic value formula. This formula takes into account a company's earnings per share, book value per share, and a factor representing the company's growth potential. Once you have an understanding of a company's intrinsic value, you can apply Graham's crucial principle of the margin of safety. The margin of safety acts as a buffer, ensuring that you purchase assets at a significant discount to their intrinsic worth. Determining intrinsic value is not an exact science. It requires careful analysis, judgment, and a forward-looking perspective. By embracing Graham's principles of intrinsic value and margin of safety, investors can make more informed investment decisions. Remember, as Graham emphasized, the intelligent investor is a realist who sells to optimists and buys from pessimists. While quantitative analysis is crucial in evaluating investments, Benjamin Graham also stressed the significance of qualitative factors. These factors provide crucial insights into a company's long-term prospects and its ability to navigate the complexities of the business world. Qualitative analysis delves into aspects such as the company's competitive landscape, the strength of its brand, the quality of its management team, and its ability to adapt to changing market dynamics. One of the most crucial qualitative factors, according to Graham, is the quality of a company's management team. Even a company with strong financials could falter under poor leadership, while a company with a competent and ethical management team could overcome temporary setbacks. When assessing management, investors should look for signs of experience, integrity, a clear vision for the company's future, and a track record of making sound decisions that benefit shareholders. Another crucial qualitative factor is the strength of a company's brand and its overall reputation in the marketplace. A strong brand can be a powerful asset, fostering customer loyalty, commanding premium prices, and providing a competitive edge in the market. A company with a strong brand and a positive reputation is often better positioned to weather economic downturns and maintain its market share over the long term. In today's evolving business landscape, adaptability to market dynamics and technological advancements is crucial. Investors should assess how well a company responds to industry disruptions and emerging technologies. Look for companies that innovate, invest in R&D, and embrace new technologies. Companies slow to adapt risk being left behind, impacting profitability and growth. Quantitative analysis, examining a company's financial performance through key ratios, is essential for any intelligent investor. Financial statements, balance sheets, income statements, and cash flow statements offer a snapshot of financial health. Calculating key ratios provides insights into profitability, liquidity, debt levels, and financial stability. Combined with qualitative assessments, this analysis offers a comprehensive view of investment potential. Benjamin Graham emphasized several key ratios that remain cornerstones of value investing today. One crucial ratio is the price to earnings, or PE ratio, comparing stock price to earnings per share. Another important metric is the debt to equity ratio, indicating a company's leverage. Return on equity, or ROE, reflects profitability in relation to shareholders' equity. Comparing financial ratios to industry averages helps assess a company's health. For instance, a declining ROE might indicate struggles, while a rising debt-to-equity ratio signals risk. No single ratio tells the whole story. A holistic view involves multiple ratios and qualitative factors. Quantitative analysis is powerful, but best with qualitative assessments. Numbers show financial performance, but miss competitive landscape and management strength. Blend quantitative and qualitative insights for informed decisions. investment is most intelligent when it is most businesslike. The importance of not putting all your eggs in one basket. Diversification is often referred to as the only free lunch in investing. It can reduce risk without sacrificing returns. The principle is simple: don't put all your eggs in one basket. Diversification begins with allocating your capital across different asset classes. The most common asset classes include stocks, bonds, and real estate. Stocks, representing ownership in publicly traded companies, offer the potential for higher returns but also come with higher volatility. Bonds, representing loans you make to governments or corporations, typically offer lower returns but are generally less volatile than stocks. Real estate, encompassing residential or commercial properties, can provide diversification and potential appreciation, but can also be illiquid. Diversification doesn't stop at the asset class level. It's also essential to diversify within each asset class. For instance, within stocks, you can further diversify by investing in different sectors, like technology, healthcare, consumer goods, market capitalizations such as large cap, mid cap, small cap, and geographical regions, including domestic, international, and emerging markets. This approach helps reduce the impact of any single sector or region experiencing a downturn. Similarly, within bonds, you can diversify by investing in bonds with varying maturities, such as short-term, intermediate-term, long-term, and credit qualities, like investment grade and high yield. Effective diversification means balancing your risk tolerance, time horizon, and financial goals. Younger investors might favor stocks, while those nearing retirement may prefer bonds. Regularly review and rebalance your portfolio to stay aligned with your objectives. Diversification is ongoing, adapting as your life changes. The rise and fall of a growth darling. In the late 90s, the tech boom gripped the market, and investors clamored for a piece of the rise of internet companies. One such company, Pets.com, captured the imagination of investors with its promise of revolutionizing e-commerce for pets. The company's stocks soared, fueled by hype and speculation, despite limited revenue and no clear path to profitability. A value play that stood the test of time. Consider a well-established consumer goods company, Amazon, a steady performer for decades. Known for its iconic brands and wide moat, it weathered economic downturns and market cycles. In the late 90s, its stock price lagged behind the market, out of favor. Value investors recognized an opportunity. The perils of ignoring red flags. The tech company, Pets.com, despite its meteoric rise, exhibited several red flags that should have given investors pause. Its business model was unproven, its revenue growth was unsustainable, and its management team lacked experience. However, blinded by the allure of quick riches, many investors overlooked these warning signs, justifying their decisions with the belief that the company's first-mover advantage would ensure its dominance. The power of patience and discipline. Value investors saw Amazon's stock price detach from its intrinsic value. They knew the company's strong brand and consistent earnings provided safety. Practicing patience and discipline, they were rewarded long-term. This case shows the importance of sticking to investment principles. The enduring wisdom of the intelligent investor. Benjamin Graham's The Intelligent Investor is a timeless guide on navigating market complexities and psychological biases. We've explored Graham's principles, from investing versus speculating to intrinsic value, margin of safety, and long-term thinking. By applying these principles, you can invest with clarity, discipline, and confidence, increasing your chances of achieving financial goals.